Imagine this: the European Central Bank, the powerhouse steering monetary policy for the Eurozone, declares it's perfectly fine with keeping interest rates exactly where they are, even as inflation hovers precariously close to dipping below their prized 2% target. This stance could have ripple effects across economies and households. Intriguing, right? But as we dive into the latest developments, you'll see why this might just be the calm before a potential storm. Let's unpack it all, step by step, like old friends chatting over coffee, and I'll make sure to explain the nitty-gritty for anyone new to the world of central banking. Picture this scene: European Central Bank, ECB, Vice President Luis de Guindos stepping into the presidential palace in Nicosia, Cyprus, on October 4, 2023, for a sit-down with President Nikos Christodoulides. It's a snapshot of international diplomacy mixed with economic strategy, captured by Reuters photographer Yiannis Kortoglou. For licensing details, check out Reuters Connect at https://www.reutersconnect.com/item/. From Frankfurt, Germany, on November 6, Reuters reports that the ECB is feeling pretty good about its current interest rate settings. According to Luis de Guindos, the bank's vice president, any slight dip in inflation below that 2% sweet spot isn't something to freak out about, it's just a blip on the radar. Think of it like a minor detour on a road trip, the destination remains unchanged. To put this in context for beginners, the ECB's 2% inflation target is like the North Star for Eurozone monetary policy. It's designed to keep prices stable and encourage spending and investment without letting inflation spiral out of control, which could erode purchasing power, or deflation creep in, which might stifle growth. For most of this year, inflation in the Eurozone has been dancing just above that 2% line, thanks in part to factors like energy prices and supply chain hiccups from global events. But forecasts suggest it might sneak below next year, and some ECB insiders are worried this could mess with people's expectations, locking in those ultra-low inflation levels we saw in the sluggish years before the pandemic, kind of like how a bad habit sticks around if you're not careful. But here's where it gets controversial: is the ECB playing it too cool here? If an undershoot happens, it'll be temporary, de Guindos assured during a webinar with Natixis CIB. We're comfortable with the current interest rates, he added, emphasizing that the baseline now is a smooth convergence to 2% without any wild swings up or down. This puts a positive spin on things, but critics might argue it's risky to dismiss potential deflationary risks so lightly. After all, history shows how persistent low inflation can dampen economic vitality. What do you think? Are they being wisely optimistic, or dangerously complacent? Share your take in the comments. Financial markets seem to mostly buy into this narrative, with investors largely aligning with the ECB's view. That said, they're still hedging their bets, pricing in a small possibility of further easing measures to keep inflation from drifting too far off course. While a rate cut in December looks like a non-starter, there's about a 40% chance in their eyes of one happening by mid-2026. It's like betting on a horse race: you root for the favorite but keep an eye on the underdogs. De Guindos pointed to the bright side of recent data, noting that inflation updates have been encouraging. For instance, the slowdown in services price growth, which includes things like haircuts, restaurant meals, and travel costs, often the toughest part of the inflation basket to tame, has bolstered confidence in the ECB's forecasts. And this isn't just about prices. Solid economic growth readings in recent weeks add another layer of reassurance. The Eurozone, comprising 20 countries, is chugging along at around 1% growth or a tad higher, matching its potential output. That's the sustainable pace without overheating or fizzling out. Picture a car cruising steadily on the highway, nothing flashy, but reliable. Wrapping up, de Guindos revealed that ECB policymakers are now marginally more upbeat about the future, seeing the bloc on track to hit their projections. This optimism is fueled by that steady growth and tamed inflation components, painting a picture of stability. The article was reported by Balish Karani and edited by Alex Richardson and Tomasz Janowski, adhering to Thomson Reuters Trust Principles. Learn more at https://www.thomsonreuters.com/about-us/trust-principles.html. Now, this is the part most people miss. In an era of unpredictable global shocks, from climate events to geopolitical tensions, how much faith should we put in these temporary assurances? And could the ECB's comfort level inadvertently lead to future challenges, like sluggish spending or even recession risks? It's a debate that's heating up in economic circles. Do you agree with Guindos' take, or do you see hidden pitfalls? Drop your thoughts below. We'd love to hear from you, whether you're an expert or just curious about how this affects your wallet. Let's keep the conversation going.